Here we go again. I'm Thomas, and in this video we will talk about a lot of very interesting things, such as the super meta earnings, which is not as good as we thought at first, the absence of the money printing in the European Union, and of course we will see the crash of the US employment sector. And there is something more, a very interesting thing on the chart of the S&P 500, so the SPY. But before we start, let's see what happened in the last week. It was an eventful week. Joe Biden announced that he would run in the 2024 election. However, we don't know if he managed to head in the right direction of the podium this time. And there is a wow. Tucker Carlson was fired from Fox News, causing an $800 million value drop in the company's stock. There is no need to worry about Tucker Carlson. He will do well with this later on, but the outcome of Fox's move will be questionable. And here is the diamond part from the last week. The Meta earnings arrived, in which the company announced its performance for the previous quarter. The quarterly revenue showed $28.6 billion, which is higher than the expected $27.66 billion. Since the data was better than expected, everyone stocked up, so those who get the data and quickly react have arrived. However, there are those who do a little calculation beforehand. The previous quarter's data from 2022 Q4 showed a revenue of $32.1 billion. So, expectation or not, the company performed $4 billion worse compared to the previous period. In addition, the annual revenue fell by 24%, which we only see if we look at the balance sheet, as newspapers now report the positive news that we have performed better than expected, but when it turns out that we performed worse than previous, the question should arise as to whether the company is really doing well. Obviously not, it's not performing well at all. So the question will be how those who think with big money will assess this situation. And what they look at, for example, is data like the success of ad impressions, which increased by 26%. This leads to a 4% increase in advertising revenues, but with the 17% decrease in advertising prices, the company has actually started to experience significant revenue losses here as well. So the company is trying to offset these losses with layoffs, which will affect an additional 20,000 employees. This is a huge number, a huge saving of money. So it's great that those who react quickly have stocked up well, but whether this will be a lasting rise will be determined by how the big fish assess Meta's opportunities, as it currently does not produce good numbers, on the contrary. So, knowing this and not expecting too much from the last week, let's say what is going to happen this week. On the European front, a very sluggish stock market opening is to be expected, as alongside the Chinese and the British bank holidays, Switzerland, France, Germany and Italy will also their banking sectors on holiday. Nevertheless, Canadian and US manufacturing PMI data will be released. So after a not too interesting Monday, the importance of the data arriving on Tuesday speaks for itself. First, the Australian cash rate is released, which determines the Australian interest rate. An announcement related to this will be made immediately afterwards. Then we can take a look at how the European money supply develops with the M3 money supply, which is an excellent indicator for confirming the bull or bear trend. There will be a European Union CPI estimate, which is a forecast of inflation data, and by the way, a core version will also be released. Then, from the US job openings, we will find out how many jobs were created in the United States, and finally, the US Wards total vehicle sales will provide information on American car sales. What we have a look is the Eurozone. The M3 money supply is not a data that has a direct impact on the euro exchange rate on its own. However, it is very useful information to determine the amount of money circulating in the economy. To simplify a bit, the less money there is in circulation, the lower the likelihood of a bull trend. And even if an increase occurs due to other economic reasons, the extent of the increase can be significantly influenced by the fact of low money supply. And this is precisely the situation in the European Union currently. Excluding the stagnation in September and October of last year, the money supply has been continuously decreasing since the peak in February 2021. Going back in time, in the 5th month of the decline, we could clearly see that there was a significant reduction in the amount of money while stock prices were rising, so we could have anticipated the outcome, which arrived later. That's why an increase in the data will be important to confirm the stability of a potential bull trend. So now let's see what's going to happen on the next day, which is Wednesday. Could actually blow the fuse for those who would like to see a lot of money printing and interest rate cuts if they want. And indeed, the market is starting to understand that. New Zealand employment data will arrive first, followed by the EU waiving the unemployment figures. This is followed by the US non-farm employment data, a PMI number from the services sector, and then Uncle Jeremy Powell can come with a machine gun. What we're gonna have a look is the ADP non-farm payroll. Last month I explained what this data is exactly and what it means. It means that on Friday we will have the spicy bloodbath, which this data is forecasting somewhat, and which will cause quite crazy movements in the market, but we will mostly experience it on the DXY chart, which, by the way, almost affects everything. From the trader's perspective, this represents the appearance of volume. Which chart will be important in terms of volume will be revealed that day with our Forex momentum following indicator. Economically, we do not expect significant changes right now, and that is exactly what we need to pay attention to. Employment is quite flat already, and we expect flat data somewhere between 250 key and 130 key. Our current data is 145 key, so if it jumped to 200 key, for example, just because of the magnitude of the jump, there would undoubtedly be a very positive swing on the DXY chart. However, within the mentioned range, it does not represent a change economically. But if we go beyond these thresholds values, serious calculations will begin. And the market is always drastic when something unexpected happens. Fundamentally, a decline in the data would be evident alongside the rise in unemployment figures. But as I mentioned, the 250 key figure still has no economic effect, but we could see some positive movements on the DXY charts, that's for sure. So after the other very important data I will be revealing in the Discord server, on Thursday some tougher data is already coming. I added a new one to the ones to watch, which is the Challenger job cuts from the United States, which give us a very useful forecast, especially in this situation. You can definitely find the details at the Pro Levels Discord server. Then there will be a European Union interest rate issue, no need to tell you why it is very interesting to us, unemployment claims from the United States, followed by a European Central Bank press conference, presumably with this cute lady here. And some additional information. Let's not confuse the unemployment rate and the unemployment claims, because some of you do. So the claim is the number of people applying for unemployment benefit. As with every Thursday, the claims will be released, while the rate indicates the actual unemployment, which costs serious money for the government, so the number of applicants is a forecast to the rate. That's why we need to see the previous mentioned data as well, such as the change in the numbers of employed on Wednesday. So this is the US ADP non-farm employment change, which I was talking about, and the earlier mentioned Challenger job cuts. So now you can see why this is a very important data. From these data, we will draw more accurate conclusions about the continuation or consolidation of the increase, which can be important from the perspective of the DXY movement. Currently, we have a higher chance of the data increasing, which could put negative pressure on the DXY if no other significant data or event counterbalances it. Since an ECB interest rate hike is also expected on this day, it is likely that nothing will counterbalance it, but Friday is a different question. And speaking of Friday, let's see what is going on there. On Friday, Canadian employment data will arrive. They are fundamentally important from an economic perspective, but due to the subsequent unusual monthly bloodbath non-farm event, they will practically have no effect as the most dominant US dollar burst into the playground with these non-farm data. So let's see them from a little bit closer perspective. The usual first Friday of the month madness in the market. Changes in the average hourly earnings data is starting to become alarming in the United States, at least from the perspective of the employed. Since the outbreak of the pandemic, the average increase of 0.4% does not really cover the extent of inflation growth, which means that people are continuously losing their salary purchasing power. This is, of course, understandable for economic reasons, as we pull the handbrake to the breaking point to slow down the economy. But understandably, it is painful for people. However, it becomes more and more painful. It increasingly restrains the purchasing measure and increasingly affects the market reaction. Here, a value above 0.5% could have a very positive effect on the stock market, while a consolidating or sinking reading is negative, and our current data is 0.3%. Meanwhile, the non-farm employment change will not be too much of a surprise after Wednesday's forecast values unless there is a drastic difference between the two. So between the Wednesday's ADP and Friday's employment change data. However, it can support or counterbalance the hourly wage data. If our first data increases, and this could potentially go above 500k, which is quite unlikely given that everyone is literally being fired, it supports the direction as long as if we get two different effect data, the impact of the one that is currently much more influential in the trading and investment environment will be stronger. In this case, employment is the stronger one. But the third piece of data enters this boxing match, and that is unemployment claims, which also received a forecast-like weekly data, as I mentioned, on Thursday, but its effect must be noted in the same way as I mentioned in the previous two cases. So three pieces of data will weigh in on how traders react to the changes in the short and in the long term. So knowing all these, let's have a look what is going on the market really. The stock market finished in a very mixed picture again. Basically, we could say we didn't move anywhere, but one sector stands out as a whole, and that is the non-durable goods, where not many negative weekly closings occurred. The tech sector is not doing well either, but due to the largest capital companies, the ETFs slightly pulled themselves up for the weekend. However, neither of them reached a new high point, so only the stocks shine on their own. Out of these, Meta performed the best, but it didn't have a particularly good trading day either. For 2 days, it closed where it opened, with a huge Thursday gap. The jump outside trading hours is nice, but the Wall Street put quite a bit of short pressure on it, so it is legitimate for many to consider the possibility of a gap closing. It is a pretty big gap, so it won't be a short story to close unless everything collapses to the basement again. However, very interesting thing was observed on the S&P 500 SPY chart among the ETFs. We cannot necessarily declare the end of the current rising wave, so this one, as the structure break cannot be confirmed as long as it tries to build a new higher high level. However, it can be observed that the MACD has already formed its peak and has started to move downwards, as you can see on that situation. In the past 2 years, we could observe this 3 other times. After a wave, the MACD formed a peak with its fast-moving average at the peak. However, not long after, the price movement reached a new peak, or almost a new peak, but the MACD was unable to reach new highs with its short moving average. This, without exception, turned into a correction in the past 3 instances, and interestingly, even within the bull trend, it showed exactly the same results, only logically the correction was smaller a little bit. It's a very interesting thing, which has so far represented the last breath of a rising phase, so it will definitely be worth keeping an eye on it on the next week. There was a lot of chopping on the forex market this week, by the way. But the guys on the Pro Discord were quite vigilant on the lower time frames. However, the mentioned Japanese Friday macro package brought its effect with a negative movement for the JXY, while the euro was quite dynamic, so this wasn't a very difficult selection, to be honest. Next week, however, absolute DXY dominance is expected with Wednesday, Thursday and Friday data, so our attention can shift to weakening currencies such as the previously mentioned Australian and New Zealand dollar and the Japanese yen, of course. And so we had a crypto week closing with a slightly bloody hue, but it wasn't that tragic everywhere, in fact. Our volume indicator shows that we performed a tiny bit better in the weekly cycle than the previous week, but we are still in a so-called sleeping zone. The total market cap is currently helpless as it still wanders in the zone, and the piercing of the doji candle after Wednesday's unpleasant day provided an opportunity for a head and shoulders formation. At this point, it's far from certain that it will happen, but if the neckline falls by the May 14th cycle close, it would also mean leaving the zone downwards, and then the overrun of the 200 exponential average, visible in blue, could be discussed. Such a move would greatly influence Bitcoin, and the biggest question will be how well Ethereum can stand its ground. Leaving the zone upwards at the 1.26 level is still an option for the bulls, in which case it could enter a nice, completely free and clear buy scalping zone, with the next resistance at 1.47 upwards. I hope this information was helpful for you. And remember, at the pro level, we analyze every major macro data and draw the proper conclusions when they arrive. If you want to join, visit our website, link in the description below. In the meantime, I would love to hear your thoughts and opinions in the comment section. If you want to stay informed about next week's data and other useful information, subscribe and turn on all notifications. And if you enjoyed the video, give us a thumbs up so it can reach more people. See you in the next video.